Accounting. So, in accounting, we are going to see so many topics for today. So, in accounting, we are going to see introduction, nature and purpose of accounting, accounting concept, accounting conversions, and bookkeeping, double entry bookkeeping, and accounting standards, and journal entry and example of Mr. Nirmal's transactions, and trial balance and for its example, final account and financial statements and its examples. In first one, we're going to see introduction of accounting. So, what is accounting? We are going to see introduction. So, accounting is a language of business. Purpose is to communicate business operations, results, and financial health. It's defined as the art of recording, classifying, summarizing financial transactions, and interpreting results. Bookkeeping is recording transactions. Accountancy includes interpretation and compilation. Now, the nature of and purpose of accounting. Keeping systematic records to know profit or loss, assets, liabilities. And another one applies to profit and non profit institutions and involves classification, recording like bookkeeping, summarizing, interpreting financial data. And next one, we are going to see accounting concepts. What are the accounting concepts? First one, definition of accounting. Process to prepare and record financial transactions and organize bookkeeping is called accounting. And one more is ensure uniformly and consistency in accounting. Okay. And next one, importance of accounting. Well, what is the importance, basic importance of accounting while we use in business? Consistency and comparability in financial reporting. And second one, risk management through cautious reporting. Cautious reporting and supports informed decision making and enhances creditability of financial statements. Credibility. Okay, so these are the four basic importance of the accounting. And then we are going to see the types of accounting concepts. We see the concepts, what are the definition, importance. Now we are going to see the types of accounting concepts. How many types are there? Well, here are the 8 types. So first one is going concern concept. Going concern concept, and it is about assumes business will operate indefinitely. Assumes business will operate indefinitely. And second one is affects asset valuation on financial statement. And next one is business entry concept. Business is distinct from its owner and separates personal and business finances. Third one, accrual concept. Revenues and expenses recognized when earned or incurred, not when received or paid. It only when earned or incurred. Next, fourth one, monetary measurement concept. Monetary measurement concept is only monetary transactions are recorded. When new transactions are done, then only monetary transactions which were recorded. And fifth one, accounting period concept. In business activities are in the business activities are divided into specific period of reporting. So in that period of time it will use. And next one is dual aspect concept. Dual aspect concept is two types. Every transaction has two types, debit and credit. And one more is maintains accounting equation. Asset equals to liabilities plus equity. Means equity is equals to asset minus liabilities. Liabilities equals to asset minus equity. These are the two equations in it, dual aspect concept. And next one, revenue recognition concept. Here revenue is recognized when earned regardless of payment timing. Okay. And last one in types of accounting concepts, historical cost concept. Historical cost concept means we can see in the title of it, historical cost concept. Assets recorded at original purchase cost. When assets are recorded at original purchase cost, it's called historical cost concept. And after that, we are going to see examples of accounting concepts. For each concept, we have a one example, like a going concern, machinery values for a long term use. We already see what is going concern concept. Assumes business will operate indefinitely and affects asset valuation on financial statements. So, for the example, machinery value for a long term use, it will be long term for a long period of time. And second one, business entity. So, here, business entity, we can see business is distinct from its owner and separates personal and business finances. So, for the example, is personal expenses not recorded in business books, which we use for a personal reasons. Okay, and next one, accrual. Accrual. We already see accrual concept is revenues and expenses recognized when earned or incurred, not when received or paid. So for that one, we are here example. Service provided in December recognized as a revenue, then payment received later. So for the December month, we recognize it as a revenue, but after revenue, we will have to pay some amount for it because we have taxes, rents, salaries, wages, so many. So after December, we will pay. Okay, so like that. And monetary measurement. In monetary measurement, we can see only monetary transactions are recorded. So only monetary values recorded. Only monetary values means when we are when the values are recorded, then it will be monetary. Okay, next, accounting period concept. We have accounting period concepts means business activities are divided into specific period of reporting. specific period of reporting. So in specific period of reporting, we have a example for it. For it, quarterly financial statements means quarterly, 4 or 6 or 8, what may be. For financial statement will be recorded for that time only. If you set it as 4 months quarterly, so 4 months once it will be accounting will be repeated, means financial statements will be repeated. So I paid salaries before 4 months or a rent before a 4 months, then I will pay after a 4 months, and next 4 months I will pay next time. So that's the what the quarterly financial statements. This is the accounting period like this. And dual aspects. Dual aspects means it has a two types of it. One is debit and credit, and another one is a equation, means assets equals to liability plus equity. So liability plus equity. So these are the two types of dual aspect concept. And in dual aspect concept, the example is loan recorded as a liability and cash as asset. So asset means which we have liability and which we have to do. The loans are recorded as a liability because loans we have to clear it, and cash is an asset because we have for next we are for user. So we already have that, so it's as an asset we have to pay, so it's a liability. And next one, revenue recognition concept. Revenue recognition concept is revenue is recognized when earned regardless of payment timing. So for this, software license revenue recognized on sale. Okay. And historical cost, well, assets recorded at the original purchase cost. Historical cost, building recorded at purchase price. When the building is built, at that time it has one price, and when we purchase it will be different, but we record the first price which when it built, so it's called historical cost. So these are the accounting concepts. Now we are moving to next one, accounting conversions. Let's see the definitions of it. So guidelines for unclear of complex transactions and not legally blinded but generally accepted, and maintain consistency in financial statements. So these are the definitions. And next one is importance of it. Accounting conversions importance. Standardized practices across different entities. Standardized practices across different entities. And second one provides common understanding for interpreting financial data and controls representation of monetary values. And last, ensure reliability and comparability. Ensure reliability and comparability. These are the some basic importance of accounting conversions, and in that we are going to see types of accounting conversions. It has four types. So first one is conversion of conservatism. Okay, sorry, conversion of conservatism means record lowest value when two values exist. Record lowest value when two values are exist. Okay, when we have two different values. One is like example 1 and another one is 17. So we have to record the lowest value, means 1. Okay? And next one, underestimate profits or assets to account for possible losses. See, so underestimate profits and assets to account for a possible loss. You have to underestimate the assets you have to account for possible losses to minimize the loss. When we are seeing the any organization or company, they want to minimize the profit and minimize the loss and maximize the profit. So this the process where all the companies will do because they want maximum of profit. So underestimates profits or assets to account for possible losses. Okay. And next one, conversion of materiality. Materiality means only significant information affecting decisions is disclosed. Only significant information affecting decisions is disclosed. Okay. And because materiality varies by organization size and context. Okay. So here the materiality means the structure and the work or the money, what we take, furnitures, everything. Okay, materiality varies by organization size and context. How the organization structure is, how the organization works, and how the organization communicate with others, and how the organization is getting revenue. These are the concept. Okay, in the conversion of materiality. And next one, conversion of consistency means use same accounting principles year after year. Means enable meaningful financial comparisons over time. If you using same rules and principles year after year means if you are following, you have to come at a 9 a.m. and you have to go 4 p.m. and this is the timing you have. So you'll come at 9 and go for 4. So after a year, you have to do the same. So this type of principle is used in the accounting. Means you will get at that time you will get a March 31st the last revenue, and you will start April 1st a new accounting book, and after 1 year means after 1 year you will close that account at March 31st only, not you will repeat it. And next one, conversion of full disclosure. So we already know what is disclosure. So conversion of full disclosure, disclose all relevant financial information fairly and completely. Disclosing, when you started you have to close the account, so you started at April 1st and you have to disclose at March 31st for the next year. So you started at 2024 April 1st and you have to close that account, disclose that account at the March 31st of 2025. So this is the four types of accounting conversions. And after accounting conversions, we are going to see what is bookkeeping. So in a small one, we are going to see what is bookkeeping. So let's say what is bookkeeping. It's a process of recording and organizing all business transactions. Well, means if you are doing some work and you are going to spend some money, so you are going to record what type of item I am going to purchase, where I am purchased, and from whom, and how much money I spent, and how much money is remaining in my account. Like that is the bookkeeping. And integral to accounting focus on daily financial transactions, day to day transactions it will be recorded. And accuracy in bookkeeping ensure accuracy in accounting. Well, you are doing for a day, right? So it's a easy task for a bookkeeping, so you have to do a day by day. So you can see, okay, this day I done this, okay, this day I done this, next day, yes, I done this. So you can see accurately also. If you missed, it will be problem. Okay. And after bookkeeping in accounting, we are going to see next concept is in accounting double entry bookkeeping. In bookkeeping, we have two types of bookkeeping. First is single entry, and another one is double entry. If you do in a single entry, you only record the payments only. So when the payments done, you don't have the receipts or any other. You see the payments only. So it will, if you have a credit, you don't have debit. If you have debit, you don't know the credit. So for the single entry is very difficult. So every organization, every even bank also do the double entry bookkeeping system. So firstly we are going to see what is double entry bookkeeping. So every transaction records in at least two accounts. Means it also follows the assets equals to liability plus equity. It follows the two accounts. Means if you are cash and if you are bank and someone send you a money cash, so then he will be a one account and bank will be a second account. So it is two accounts. Okay, who I bought the cookies, for example. So I bought a cookies for 50 rupees from whom? So first account will be mine and second account will be him. So we will be seeing that to and by, and between it we are a debtor. Okay, in we can see it in problems. First we see this one. And what are the advantages of double entry bookkeeping? Ensure financial accuracy and reduce fraud and errors, provides clear financial picture, and facilitate financial reporting, balance sheet, income statement, cash flow, etc. And aids tax compliance and enhances business credibility, supports business growth, helps budgeting and forecasting, ensures compliance with accounting standards, simplifies auditing. So when you're doing this, it will be simple. These are the sum of advantages. Well, 10 advantages. Yeah, these are the sum of advantages. And we also have disadvantages of double entry bookkeeping. So it's have advantages but also have disadvantages. So we are going to see disadvantages. So what are the disadvantages of this double entry bookkeeping? Complex for small business. If you have a small business like a small store, double entry bookkeeping will be very complex for you. Okay, and requires accounting knowledge. For you have to do a double entry bookkeeping, you have to study about the accounts, how to do the double entry. For it, it will be required accounting knowledge for you, and it time consuming. It will take a lot of time when you calculate it, and high initial costs. If you want to do that, you have to initial cost will be very high, risk of setup errors. If you are doing that, it will occur somewhere errors for you and needs regular maintenance. To time maintenance will be very neat for it, and necessary for not necessary for all business. If you want to do a double entry business, it's not necessary for every. If you have a store, you don't need that. And if you have a business, yeah, it's need that. And if you don't have that much business, you have a small store, and I have a cookie store, a bakery, with a bakery or a salon. We don't need that much necessary of all business this double entry, and can overwhelm beginners. It can be very difficult for a beginners, and risk of over complication means it's a complication will be very risky. If you maintain this, you have to be some accounting knowledge, and you have, if you have some experience to do that, you can manage it. But without this, risk of over complication and requires advanced software. For doing it, you have to know what the software you are going to use in it. So these are some disadvantages. Okay, and next we are going to see accounting standards. So what are the accounting standards? We are going to first definition of accounting standards. Common structure of classification, recording and presentation of financial data, and ensures consistency across organizations. It is called as accounting standards. And and one more, after definition we have list of mandatory accounting standards. Okay, so there are some mandatory accounting standards, and ICAI and MCA in India. So first one we are going to see is one, disclosure of accounting policies. So mainly is disclosure of accounting policies means section or anything. Yes, one accounting, you can see accounting standard 1. Accounting standard 1 means disclosure of accounting policies, means disclosure of significant policies followed in a financial statements. Second one, valuation of inventories. Valuation of inventories. What we have the inventories. So valuation and the cost of ascertainment of inventories. Third one, cash flow statements. Preparation and classification of cash flow. And fourth one, contingency and events after balance sheet date. Treatments of contingency and post balance sheet events. And fifth one, net profit or loss, prior periods, changes in policies. Mm, Prevention of profit or loss, including extraordinary and period times items. Now, what we have to recycle it, or we have to import some items, or we are getting any loss by the items, we have to throw out, like this. Periods, change in policies, like this. And seventh one, Construction contracts. Accounting for construction contracts means what we are going to build, like not only as a structure of a building, it's also our like work, as per a work, a basis of work. We can say that what type of team we are building, what type of work we are going to build, what type of relationship we are going to build, like that also. And revenue recognition of revenue for ordinary business. Okay, so I'm so we are going to do a summary of it, give a summary, so it won't be necessary for it. So I am going to see this only. And next one, 10th one, property and equipment. Sorry, property and equipment. So property and equipment is nothing but accounting treatment for a property, plant, and what are the equipment we need. Equipment, not equipment, it's equipment. Sorry. And next one, effect of changes in foreign exchange rates. Accounting for foreign currency transactions and fluctuations means we have here rupees in foreign some areas, like if take America dollars, Korea yuans, and China yuans, wons, like that. And 12th one, government grants. Accounting for government subsidies and incentives. When government gives projects to us, that's one, and subsidies, we are going to taxes or anything, incentives, like that. And accounting investments. When we are having some profits, we are gaining some profits, we are going to um, do disclose accounting, well, we are having where accounting investment, right? So accounting investments means accounting disclosure for investments. So when we are doing some investments, that investment should bring us some profits, so that type of accounting. And the 14th one, accounting for amalgamations, say mergers and goodwills, brand names. We can see accounting for mergers and goodwills. So when we get our profits or a merge with other company, we will see the goodwill. So for that goodwill, how much profit we got, so how much revenue we got. So that's type one. And accounting and disclosure for employee benefits except share based payment is a 15th one, employee benefits. Okay, accounting and disclosure for employee benefits except share based payment. When share based payment is occurred, we don't share with employees. It accounting for employee benefits means their PLs and cut-offs, bonuses, these are their benefits. And also their expenses, like scholarship for their children's, hospitality, and more. Okay. And 16th one, um borrowing costs. Accounting for borrowing costs. When you are started a company, you will borrow some amount of money from banks and investors. Because of bank, it will give you interest based on you are getting a profit. If you can't, it will be very loss for you, and it will be gone for a down. to the throw state. And 17th one, reporting on financial segments. Reporting financial information for segments and geographical areas. If you are doing something, it should be geographical areas. And for information for segments, you have to divide it into a segments and for a geographical area. If you are selling a AC for a south side or north side, you have to see in India. If you are selling of AC is will be very profitable at the south side, because south side is a high temperatures area and north side is a low temperature area, because there will be minus degrees also. But at the south area you can't get a 10 degrees of temperature also. It will be high temperature up to 45 and above. So they want cooler. So you can your product of AC will be purchased in south side, not in a, so these are the segment. Okay, I divided into two types, north and south. And geographical area, as per I have to sell a AC, I'm going to sell in south side, because a geographical area is very hot, so I going to sell my AC on that side. And as I 18th one, related party transactions. The reporting transactions between related entities. I'm going to transact my money to that account because he gave my money. He gave in past he gave my money. He gave some money from his bank to get a profit. So I'm going to transfer some money to his account. Okay, other I'm I invested some money in some other place, and they got profit, and they're going to transfer some amount to me. So this transaction will be noted in accounting. Okay, and next one, accounting policies on lease transactions. So accounting and disclosure for finance and operating leases. Okay, and 21, earning per a share. Principles for determination and present. When you are got a share, if you a company, it will be 100% of share. So in that, how much percent of share did you have? 1%, 5%, 25%, or 70%? How much share you earned as a earning per share? If for a share, it will be very, if you have a share of 8 rupees, what will be for a 10, it will be 80. And after 10 years, per share it become 10 rupees. Then you will get a profit of 2 rupees per share, right? So like that. So and next one is consolidated financial statements. Preparation and presentation of consolidated financials. 22. Accounting for taxes on income. Income taxes. Treatment for income taxes accounting. And investment associates, accounting for associated in consolidated statements. And 24, discontinuous operations, reporting of discontinuous operations. And 25th, interim financial reporting, minimum content and measurement for interim reports, interims. And 26 one, intangible assets, the assets which are intangible. So accounting for non-meta assets without physical substances. We have the book accounts, but the materials are not for like if you see um, which type of assets which we can't gather in one place. Okay, so that's our intangible. We can't touch that one. And joint ventures, accounting and reporting interests in joint ventures when joining with two or more ventures, joint ventures, and impairment of assets, producers for ensuring assets are not. And at the last, we are going to see 29th one, contingent liabilities, contingent assets, provisions, recognition and measurement criteria and disclosure. These are some of them. And after it, we are going to see journal entry and examples. We know what is journal entry. After bookkeeping, we are going to see journal entry. After journal entry, we will be record trial balance. So, journal entry, for example, of Mr. Nirmal's transaction, um, capital, introduction, purchases, sales, returns, drawing, assets, asset purchases. These are included in journal entries. And entries included debits and credits for cash, goods or stocks, creditors, debitors, drawing, assets. These are will be. If capital, which one? For what? For okay. And trial balance example, Shining Brothers Private Limited, list debited on credit balance of account as March 31st, 2017. It will be uh, it will be shown in the PDF in briefly. If you want a PDF, you have to message me. And financial accounts and financial statements examples, like common balance is March 31st, 2018. It's also an example. And second one is Nagarajan's balance is March 31st, 2016. It includes purchases, sales, stocks, expenses, assets, capital, creditors. And if you are done that bookkeeping after general entry after trial balance of finance accounts means tri means it's a trial profit and loss accounts. Okay, it have both sides, debit and credit. Okay, so for the Thomas balances includes purchases, sales, stocks, expenses, assets, and capital creditors. And for the Nagarajan's balance, well, after this, we have to see the balance sheet also, and includes sales, wages, commission expenses, creditors, capital, cash, stock, debtors, and adjustments for prepaid or outstanding items and closing stock, and for the preparation of trading and profits and loss account and balance sheet. These are the process how to do a problem. Okay, and at last everyone should be done this one preparation after knowing the what is question and what are the adjustment of the questions. You have to prepare a trading and profit loss account, and at last after it you have to do a balance sheet for it. So these are the concept in fourth unit of accounting in MEFA. If you have any questions, you can ask at the comment. Thank you.